When everyone's talking about GameStop and AMC, synthetic shorts need to cover. It's a good one if you're going to do the Instagram of trading, where you only talk about the crazy ones that you won and not the other 900 million that you lost on. What's up, everybody? So today I'm going to break down synthetic shares, something a lot of people keep talking about with, for instance, GameStop and AMC. A lot of options are expiring. There's a lot of synthetic shares that need to be filled. Now, a lot of you guys have repeated this. I think a lot of people have no idea what they're saying, so I'm hopefully going to clear that up for you guys. And then maybe after this, if you're in things, pump and dump situations, I want you guys to Google and search the float. How many shares are there available? There was 50 million shares available of GameStop. That's a low float, right? That's next to nothing. Now, take this into supply and demand, right? More supply, you need more demand to move it. So as supply goes up, there's less demand. As supply goes down, demand goes up, right? It's a teeter-totter. They will always be inverse of each other. So 50 million shares of GameStop. We saw that squeeze. I'll even pull it up for you guys. We saw the GameStop squeeze right here. So that's what 50 million shares and attacking the suits can do. Wall Street Bets, you guys saw it go crazy. 50 million shares. There's synthetic shares. Options are closing. They got to get out. There's margin calls. You did grab a hedge fund by the balls there, but that was over what, 140% short, right? So they had to at that point buy shares, right? Like, hey, these puts are expiring now. When your options expire, they are exercising or you're paying that. If you want to exercise, you're buying you're buying that share price wherever it's at, wherever your strike price is at. You got to buy those shares. Your order needs to be filled, or you're paying that person the premium for it. So, 50 million shares. That's what 50 million shares looks like. AMC is not 50 million shares. Now, that same pump, you guys saw the same excitement, right? Hang on, I know we're getting a little bit higher now. So this is that same excitement. This is right now 400 million shares. That's a little bit different. It's going to take quite a bit more to move this. So a lot of you guys are comparing this movement from GameStop to AMC. Now, it's not that everybody moved into AMC. Some of you guys are saying the short squeeze hasn't even begun yet. You guys peeked at the chart lately? A lot of you guys are attacking. You guys think everyone's attacking everybody. The suits are out to get us. Right? Institutions, their job is to make money. They don't care about you. They don't know you exist. They've never cared about a single thing. Okay? You'll never get a Christmas card from it. You'll never get anything. Taking money from retail traders, we're the low-hanging fruit. We're easy because you guys are, sorry, no offense, dumb, emotional, easily manipulated. It's easy. And if you guys think they're not in the same Wall Street Bets forum with you, just seeing what kind of dumb ideas you're coming up with next, wrong. But for right now, it has entered this could be a short squeeze, pump and dump. A lot of retail just piling in because they think a short squeeze is coming. So they're driving it up. So you can watch volume. There's a lot of things you can watch. But right now, let's clear it up because you guys think there's synthetic shares. So let's jump over to the options chain. Right now, I would say this one's hard. Because a lot of people look at you and say, Don, I told you this thing was going to the moon. What do you know? Well, I know I've been doing this for a while. So pay attention, because what you're doing on AMC and GameStop, right, might have worked that couple times. Take this on the broader spectrum, and you're going to lose a lot. So enjoy the money. I'm not attacking anybody that's in this. I was in it, sold a little too soon, and I might get back in it. I don't mind pump and dumps. If stupid people are going to jump in there and hand out free money, I'll do it all day long. But for now, let's check it out. So pump and dumps typically look like this. A lot of you guys were saying AMC to the moon last time, right? Right about here. Oh yeah, here it comes. And then it went back down. Now, this is when I got in. And I wrote further. Now, I grabbed December contracts because I know what I'm doing. I'm about to explain that to you guys. So getting back in here, it pumped up. And now, because, again, how not liquid it is when you're selling this thing down, I chose to get out. So I left quite a bit of money on the table. Actually, just as soon as we left that zone, I was worried we were going to just cream it right back down. We saw the pump, no buyers, brought it right back down. That's the supply and demand aspect of things. We're just on shares right now. So we're buying some shares, bought it up. Everyone started taking profits. Now, these things gap down. They move down pretty quickly because no one is buying shares at this price. Now, there's everybody talking about diamond hands and hold the line. And sure, if you guys still believe you're manipulating markets, you know, have fun in La La Land. You're not. Sorry, I'm not here to hurt your feelings, but I'm just going to at least educate you a little bit. So that's just shares. Now, what drives shares? What drives the order flow? Right now, options contracts, futures contracts, because institutions are buying these. Market makers are buying shares because they need to remain at a neutral delta. Now, if your options guy is only explaining delta as in, if for every dollar it goes up, the contract goes up this much, he took his research that far, find a new options guru. There's about 11 different ways you can do this. I do have a full-blown options course. It's always in the link in the description. That's the teachable link. So you can learn everything about options contracts and what you're getting into. Jumping into an asset class you guys know nothing about or you think you know about is going to get you in trouble. But for now, we're going to talk about deltas. Let's find a cool color. We got green. We got a little magic pen. We're talking about this column right here. Now, they are rated per share basis. You know what that means? Right inside here. So this is at the money right here. This is deep in the money. Well, just in the money. This is out of the money. That's what the shaded options mean. I know AMC price is somewhere inside here. Right? You can look right here. It's 26.12. So after hours, we moved. If we opened up right now, since we're at 26, this 26 strike would be shaded. So like I said, these are per share basis. Same with puts, right? So delta's over here, per share basis. I'm saying that for a reason. Because this is essentially how many shares you're controlling. If you were to buy this $17 contract, one contract right now, you're essentially controlling 82 shares. Now, when they call it synthetic, options are their own asset class. They are driven by the underlying. They are not the underlying. If AMC goes away, bankrupt, they're gone, you still have this contract. Now, the contract will be worthless. You know, it'll still follow the zero price that AMC just went to. But essentially, if you guys kept buying these contracts because they have their own supply and demand, you'll still have its own movement. But so this is the June 18th of 2021, $17 strike price. You're saying you want to buy 100 shares at this. So by June 18th, you want to buy 100 shares at $17. You're going to pay about $1,100 right inside there for that contract. Now, volume, 863 people on Friday thought that was a good idea. 7,600 thought that was a good idea prior. That's how many contracts they held overnight. Theta, this is your time decay. This is right off the top how much money you're losing every day. This right here, yes, it is. If AMC goes up $1, this contract goes up 82 cents. So I just told you you're paying about $1,100. It goes up $1. It's going to cost almost $1,200 at that point. So this is when they say synthetic. This is what they're talking about. When market makers, when everyone's talking about GameStop and AMC, synthetic shorts need to cover. They're actually over here on the put side. So we're talking about this column now. That's 30. If this options contract needs to be covered, let's say we're screaming right past it, margin call. Let's get on to June 4th. That's what's coming up. This is what everybody's all excited about. These puts need to be covered. Somebody was short this, but it shot up. So right now, let's find a juicy one. Here's 31,000. That many people decided to go short. 31,000 contracts were traded that day. 1,900 held over. They went short. So they went short. They are controlling 47 shares. Now, when that contract gets covered, they're going to cover that many shares. So you are synthetically short 47 shares by buying this put. You're not actually in shares. You are controlling 47 shares. That's where the synthetic comes from. You guys have heard me talk about it when I say I'm taking a synthetically long position. This is exactly what I did inside of AMC. I went synthetically long by buying the December contracts. I went December, and I had the $5 contracts. This is the position I actually took. So, yeah, right now they're a couple thousand a piece. When I bought them, they were just shy of like 300 a piece. So I did flip the premium. But now at the time I was kind of down here because these deltas do rise, so you will control more. So instead of buying 100 shares at $5, I spent a little bit less and got to control almost, by the time I sold them, almost the same amount of shares. But I got to make quite a bit more money. I was synthetically long AMC. It was a long options. Typically, if you're going synthetically long, you're going deep in the money. I was pretty much at the money at the time. If I were to take a long position at AMC right now, it would be this position. It would be because I think by December 21st, not only is it going to be above $5, it's going to be above $25 because I got to add that premium again per share basis. That's why it's times 100. So I would need to add $21 to that. So effectively, if I were to go long AMC right now, it's because I think AMC by the end of December will be at least over $26. We close that thing at $26, I break even. So if we're above that, every $1 up is $100 for me. Probably not what I would do because I think AMC is a $20 stock. Right now we're in momentum territory. These are juiced up. We can talk about volatility in Vega and your implied volatility on a different video. For now, let's just cover synthetics. You are driving in again, synthetically long that many shares. Whatever contract you are long $9 strike, you're synthetically buying 93 shares of AMC. So to wrap it up, deltas, not exactly just the how much it moves per dollar, right? Not only are they your percentage chance of it expiring in the money, like this is about 100% chance it expires in the money. AMC will probably be above $1, at the end of the year. This is why you guys buying cheap contracts usually lose a lot of money. This is too hyped up. Let's go over to a normal ticker right now. So a lot of you guys, you buy contracts you can afford, not necessarily a good play. Very popular options contract or option strategy is selling these. I just told you it's a percentage of it expiring at the money. So if I sell you this contract right now, I collect the 800 in premium right here. I have a 70% chance I'm going to win. If you bought this from me, you have a 30% chance we even get to that price, let alone if we just went to that, I just got to keep all your money anyway. We would need to exceed this by $8. So you would need $4.44 plus $8 just to break even. At that point, I would just lose the premium. Anything above that, I would then owe you. Which is also, you'll hear these crazy gains when someone does buy a crap contract down here. I spent $4 on this. Sorry, they spent $60 on this contract. They had 4 shares. It was nothing, but it did make a crazy move up and it started to climb up. You can see how it definitely accelerates as we go. You will lose more often than not on that strategy. It's a good one if you're going to do the Instagram of trading where you only talk about the crazy ones that you won and not the other 900 million that you lost on. So deltas, very important. And some of you guys, when we're talking about deltas and you're talking about synthetic shares, that's exactly what they're talking about. There is hard deltas and soft deltas. Hard deltas, you bought the actual shares. Soft deltas, right here, you bought the contract. Here's at the money. Here's what it usually is when it's not juiced up. Here's your 50-50 chance because we don't know if we're going up or down. Your next candle is always red or green. The options market is telling you exactly that. Here's 50-50 chance we go up or down. Take your pick. Again, they're rated per share basis. So that's essentially you buying 50 shares of the S&P at 420. So again, it pushes up. You'll see these contracts go up. They are worth more. But that's the synthetic position everyone's talking about. Synthetic shares. Because I can't remember if I actually said that, and I don't really edit. Hard deltas, shares, soft deltas are options contracts because they move. If you told me right now I am in 100 deltas of the S&P, I know you have 100 shares of these SPY, or you have 2 of these contracts. You could have 4 of these contracts down here. You could have one just super deep in the money. It's not, but if we had one up here, you could have just a deep in the money contract. But again, they're moving. Soft deltas, synthetic shares. You're going synthetically long by buying something down here. Before we get out of here, let me bring up the calculator and just do the simple math right in front of you guys. SPY, it's at $420. Okay, so let's type that right. 420 times 100. Let's do 90. Let's do a real example. So 420 times 90. You want to buy 90 shares. It's going to cost you $37,000. $37,800. So almost $38,000, right? Just to own SPY. You're invested in SPY. Okay? Now, I could do that, or I could simply just buy, we did 90? I could buy this contract right here. I could buy the 220. Do I think it's going to be above 220? Yes. I control 90 shares. But let's do the simple math because it's per share times 100 shares. So it's 200. The math should be simple. You guys should follow me. Let me know if I do it too fast. Times 100. We're going to move that decimal over. I spent 20,000 and we got the same. We're controlling the same amount of shares. You bought 90 shares at 38. I bought essentially 90 shares at 20,000. Where the risk stands on options, what you guys should always understand is the nitrous. You put a deadline. At December 31st, you will still have your 90 shares. I will likely be controlling 100 shares if it went up, but if we crashed, that goes to zero. I now have an expiration date. I am now at the end of the clock where you can keep your bad habits and bag hold. Whether maybe you're an investor, maybe not necessarily bag holding, but you can keep them. So understanding if you're getting into these options, if you want to take your hand in that, it's a completely different asset class. You have effectively taken all your bad habits and put them right on the clock. If you're a bag holder, you're going to watch your account go to zero. If you know what you're doing, you put a nitrous bottle on the back of a fully built engine. I'm going to end it here. Hopefully that cleared things up for you guys. And I'll see you guys in the next video. If you ever have any questions, guys, again, all links in the description. I do have a chat. I do have a mentorship where I'm live every night. And again, the Teachable course. Teachable link is a full-blown course to teach you everything about options contracts. So you can then at least make educated decisions on what you want to buy and sell. I'll see you guys in the next video.